Ladies and gentlemen, good morning and welcome to the Q3 and 9M FY26 earnings conference call of Belrise Industries Limited. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then zero on your touchtone telephone. Please note that this conference is being recorded. Before we begin, a brief disclaimer. This conference call may contain forward-looking statements about the company which are based on the belief, opinions, and expectation of the company has on date of this call. These statements are not the guarantee of future performance of the company, and it may involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Shrikant Badwe, Managing Director from Belrise Industries Limited, for opening remarks. Thank you, and over to you, sir.
Good morning, everyone, and thank you for joining us for Belrise Industries Q3 and 9-month financial year 2026 earnings call. Joining me on this call are my sons, Sumed and Swastit, along with our CFO, Mr. Rahul Ganu, our CMO, Mr. Sunil Kulkarni, and our investor relations advisors, SGA. Belrise Industries is a leading Tier 1 automotive component manufacturer with 22 manufacturing facilities across India and France. As we look at Q3, our focus on innovation and expanding relationship has continued to drive growth. Within our core automotive business, we continue to strengthen our positioning through higher content per vehicle and expanding OEM partnerships. During the quarter, we secured a strategic order to establish a new manufacturing plant in Haridwar for one of India's largest two-wheeler OEMs. Our Chennai plant ramped up production in line with rising OEM volumes, where we are single source supplier for a key two-wheeler EV platform. Meanwhile, our Bihari plant began supplies for a premium Japanese model after achieving full operational readiness. A key highlight in the non-auto segment was the acquisition of a French company, SDM. Through this acquisition, we have now entered the supply chains of the largest civilian aircraft OEM globally, as well as a leading combat aircraft OEM. Further, we also entered into strategic partnership with Israel's Plasan Sasa to bring the flagship ATEM platform to India and to become an integral part of their global supply chain. I am also happy to announce the much-awaited merger of Badwe Autocoms and Eximus Infratech with Belrise Industries Limited. Both of these promoter entities are being merged at a valuation close to their respective book values, and hence represent a significant discount to what Belrise is trading at today. This transaction will be EPS and value accretive for all shareholders of Belrise Industries Limited from day one. I would request everyone to keep the merger presentation handy, which has been uploaded on our website and the stock exchanges, as we'll be referring to it later in the call. Coming to the results, total revenue from operations for Q3 FY2026 stood at INR 23,405 million, up by 8% year-on-year, including manufacturing revenue of INR 18,660 million, which grew 5% year-on-year. Our EBITDA and manufacturing EBITDA stood at INR 2,869 million and INR 2,579 million respectively, with margins at 12.3% and 14%. Our adjusted PAT grew sharply to INR 1,268 million, which is up by 26% year-on-year. With this brief, I now hand over the call to Swastik, who will take you through our merger and related business updates. Thank you very much.
Thank you everyone for joining the call today. I will be going through the merger presentation uploaded on our website as well as the stock exchanges. Firstly, it gives me immense pleasure to announce that the board has approved the proposed merger of Budway Autocoms Private Limited and Eximys Infratech Solutions Private Limited with our listed entity, Belrise Industries. If you turn to page 4 of the merger presentation uploaded on the exchanges, I'll walk you through the strategic rationale behind this transaction and explain why it makes strong financial as well as operational sense for the listed company and its shareholders. To begin with, these two entities together represent one of the largest players in the Indian two-wheeler plastic component segment, with a combined market share of approximately 14%. Belrise, on a standalone basis, currently has close to a 10% market share. Post-merger, the combined entity will command nearly a 25% market share in two-wheeler plastic components. This scale translates into a higher wallet share with OEMs and greater customer stickiness. Second, both Budway Autocoms and Eximys Infratech are promoter-owned entities with long-standing relationships with marquee global OEMs, including a large 2- and 3-wheeler OEM and a leading global consumer durables OEM, amongst others. These relationships have been built steadily over many years and have grown in tandem with the success of these OEMs in the market. Third, from a financial standpoint, these entities are already meaningfully scaled. In FY25, Budway Autocoms reported revenues of approximately 14 billion INR, while Eximys Infratech reported revenues of close to 7 billion INR. Profit after tax stood at INR 793 million and INR 330 million respectively. This represents a meaningful profit addition to Belrise, and accordingly, the transaction will be earnings accretive. Finally, on valuation, as discussed earlier, our objective has always been to execute this transaction as close to book value as possible. In line with this philosophy, this merger is being executed at a PE multiple of 8.3x based on FY25 numbers for these two entities, while Belrise is currently trading at a PE multiple of approximately 30.9 on a TTM basis. Given this valuation differential, the transaction will be both EPS and value accretive from day one. If we now move to slide 5, I'll outline the merger rationale in greater detail. Firstly, the merger will result in significantly simplified group structure, with related party transactions reducing materially by close to 11.5 billion INR. Secondly, the merger will also increase our content per vehicle by over 3,000 rupees, taking it from approximately 17,300 to 20,300, an increase of nearly 20%. This will also be accompanied by a greater push towards Tier 0.5 assemblies, enabling us to offer more consolidated system-level solutions to our OEMs. Thirdly, given the merging entities and Belrise already transact and operate alongside each other, the merger will also lead to a higher degree of verticalization, with all operations coming under a single umbrella. This will drive strong operational efficiencies across people, processes, and procurement. Fourth, we also expect a meaningful increase in wallet share, particularly in the plastic component segment, of over 30% with certain marquee OEMs. This expansion in wallet share will further enhance customer stickiness. And finally, as mentioned earlier, the transaction is immediately EPS accretive. Now, if you move on to page 7, I'd like to highlight a few additional data points that are worth noting. Together, these entities operate 5 facilities across Maharashtra, 4 in Aurangabad and 1 in Pune. This will further expand Belrise's geographical footprint. Their revenue mix is largely powertrain agnostic. One particularly interesting capability is Exmith Infratech's presence in the EV powertrain space, the manufacture of copper busbars, which are critical conductive components used in battery systems. Currently, these are supplied indirectly to a major Indian passenger vehicle OEM. There is also a high degree of in-house verticalization with capabilities spanning plastic molding, painting, aesthetic application, and assembly, resulting in minimal dependence on Tier 2 suppliers. Moving to page 8, in terms of the post-merger revenue mix, what is particularly exciting is the significant strengthening of our exposure to the PV and CV OEM segment. Post-merger, approximately 34% of the incremental revenue contribution from these two entities will come from the passenger vehicle and commercial vehicle segments. This allows us to continue gaining market share in four-wheelers and commercial vehicles and growth in these segments. On page 9, from people and infra standpoint, the merger will add approximately 2,000 employees to the Belrise family, including around 1,550 blue-collar workers and 400 white-collar employees. The operations of these two entities are also highly automated, with approximately 50 robots used in fabrication, around 30 machines deployed in plastic molding. Moving on to page 10, while the overall product mix is broadly similar to Belrise's current portfolio, there are two key differentiators. The first is the fairing assembly, where over 50 individual components, both manufactured in-house and sourced externally, are assembled into a complete module and supplied directly to OEMs. This is a strong example of a continued transition towards a Tier 0.5 assembly model. The second differentiator, as I mentioned earlier, is the copper busbar application for electric four-wheelers, a capability that Belrise does not currently possess and one that strengthens our presence in the EV powertrain segment. On page 11, from the perspective of awards and customer relationships, these entities work closely with two marquee global OEMs. In addition, they export high-precision engineered plastic components with tolerances less than 5 microns to a global consumer durable OEM across China, North America, and Europe. Achieving this level of precision in plastic components at scale is challenging, and Badwe Autocomps has built this capability through strong R&D in mold design and product engineering. From an awards perspective, we are also proud of receiving 2 GIPM awards from the Japanese Institute of Plant Maintenance, which is among the most prestigious global recognitions for TPM excellence. Now, if you move on to the next slide, this merger also supports Belrise's medium to long-term strategy in 3 key ways. Firstly, in deepening our two-wheeler presence. Secondly, in increasing verticalization. And thirdly, in accelerating our evolution from a Tier 1 to a Tier 0.5 supplier. As shown on slide 14, firstly, the merger is expected to drive an approximately 30% increase in wallet share in plastics for a marquee 2 and 3-wheeler OEM. And beyond the guided content per vehicle of INR 17,300 for Belrise, we see an incremental increase of around 3,000 rupees, taking consolidated content per vehicle to approximately 20,300 rupees. The flow chart on slide 15 illustrates how these entities already collaborate. For instance, in fairing assemblies, Belrise supplies the metal components, while Exmith Infratech supplies the plastic parts, with final assembly carried out at Exmith Infratech. Similarly, in exhaust systems, Belrise focuses on heavy stamping and tube processing, while Badwe Autocomps handles fabrication, surface treatment, and assembly. Bringing these capabilities under one umbrella will further enhance operational efficiencies. Moving on to slide 16, as mentioned earlier, we undertake a highly complex fairing assembly comprising over 50 individual components for a leading 2-wheeler and 3-wheeler OEM. This is tough to replicate as an extremely sticky business. Lastly, coming to the financials on slide 18, these entities generate strong profitability with a combined profit after tax of approximately 1.1 billion INR with robust EBITDA margins. Post-merger, net of related party eliminations, we expect an incremental 10 billion INR of revenue to be added to Belrise, along with a margin uplift driven by the internal RPT net off. As mentioned earlier, based on FY25 numbers, the transaction is being executed at a P multiple of 8.3x based on FY25 numbers, while Belrise is trading at approximately 30.9 P ratio on a TTM basis. In terms of advisors on this deal, Ernst & Young acted as the independent registered valuer, while JM Financial provides the fairness opinion for the transaction. Promoter shareholding currently stands at approximately 66.5% pre-merger and is expected to increase to around 67.9% post-merger, with the balance held by the public. This is of course subject to regulatory and shareholder approvals at the upcoming AGM or EGM. With that, I will pause here and hand it over to Sumedh, who will walk you through our entry into aerospace and defense and how this opens up the next phase of growth beyond automotive.
Thank you, Zasid. The quarter was particularly significant for us, with meaningful progress across both these verticals. First, during the quarter, we entered into a strategic collaboration agreement with Plasan Sasa, a leading Israel-based defense company with strong capabilities in advanced armoring and autonomous defense mobility solutions. Plasan is globally recognized for its integrated platforms and has a flagship product, the Atom, which translates to All-Terrain Electric Mission Module, which has been deployed across multiple geographies globally and at scale. The Atom platform is particularly suited for highly rugged and inaccessible terrains and is also capable of autonomous operations, making it relevant for deployment in sensitive defense zones where human and conventional vehicle movement is constrained. This strategic collaboration with Plasan is two-pronged. Number one, we will team with Plasan in India to jointly engage with the MOD, defense PSUs, and other relevant stakeholders to industrialize and productionize the Atom solution for the Indian ecosystem. The initial phase will involve assembly in India and testing this solution across diverse terrains in the country, like in remote and inaccessible areas such as the northeast and the north of India, such as the Siachen Glacier, etc. Second, beyond the Indian market, we will become an integrated manufacturing partner for Plasan's global supply chain, enabling cost-effective production of Plasan's advanced systems in India. We've already initiated prototype and initial supplies for select platforms. And over time, we expect to become one of Plasan's key partners globally for components catering to their global exports. This dual approach allows us to generate revenues while simultaneously building a differentiated defense mobility solution tailored to Indian operating conditions. In addition to this, during the quarter, I'm very happy to share that we also completed our first ever international acquisition in the aerospace segment through the acquisition of SDM, a European aerospace manufacturer specializing in high precision machine parts for aerostructures and robotics. Today, SDM supplies to some of the world's leading aerospace OEMs, including the largest global aircraft manufacturer, French fighter aircraft OEM, including the largest global commercial aircraft manufacturer, and the fighter OEM that I mentioned, and a large French robotics OEM, and various others. With this acquisition, we have entered the supply chain of all these marquee customers. To lead this business, we have onboarded the former CEO of an Airbus subsidiary, who not only has key experience in scaling businesses in Europe, but also in shifting complex supply chains globally from a supply chain angle. The acquisition was completed at an attractive valuation. SDM is expected to generate revenues of approximately 3 to 4 million in FY27, while the acquisition was done at a consideration of 0.35 million euros, implying an entry valuation of approximately 0.1x sales. This is a very strategic acquisition in nature. It's small enough to manage and gives us a European footprint to further grow our engagement in that geography. Going forward, we plan to grow the business in Europe while also leveraging SDM's technical capabilities to establish and scale aerospace manufacturing operations in India and positioning India as the best cost manufacturing hub. When we refer to best cost, we mean a combination of three specific factors. Number one, favorable labor economics. Number two, a strong engineering depth recognized globally across automotive, industrial, medtech, and aerospace sectors. And number three, India's proven ability to integrate culturally and operationally with global customers. Together, these factors position India as a preferred destination for aerospace manufacturing. Also, given the strong order pipeline of global aircraft OEMs and the increasing importance of India as one of the largest aviation markets globally, we believe this trend will continue to play out over the next 5 to 10 years, and we expect to be a key beneficiary of this shift. Let me now hand over to Mr. Rahul Ganu, our CFO, to take you through our financial performance of Q3 and 9 months of FY26. Over to you, please.
Thank you, Mr. Sumit, and good morning to everyone on the call. Let me take you through the key financial highlights. Quarter 3 FY26 consolidated financial highlights. Total revenue of Quarter 3 FY26 stood at INR 23,405 million, up 8% year-on-year from INR 21,668 million in Q3 FY25. Manufacturing revenue for Q3 FY26 stood at INR 18,660 million, up 5% YOY from INR 17,801 million. EBITDA stood at INR 2,869 million, up 10% YOY in Q3 FY25. EBITDA margin stood at 12.3%. Manufacturing EBITDA stood at INR 2,579 million, up 11% YOY, and manufacturing EBITDA margin stood at 14%. Adjusted PAT, which is excluding the exceptional item expense of rupees 64.1 million related to increase in employee benefit obligations resulting from the change in the labor law by Government of India, stood at INR 1,268 million, up 26% YOY, INR 1,006 million, and PAT margin stood at 5.2%. Export contributed 5.8% to our manufacturing revenue in Quarter 3 FY26, that is INR 1,075 million. Coming to the segmental performance on the manufacturing front, two-wheeler and three-wheeler contributed 80.6%, passenger vehicles contributed 4.9%, commercial vehicle contributed 7.9%, for Q3 FY26 and others would be 6.6%. 9-monthly FY26 consolidated financial highlights. Total revenues for 9-monthly FY26 stood at INR 69,563 million, up 16% YOY from INR 60,165 million in 9-monthly FY25. Manufacturing revenue for 9-monthly FY26 stood at INR 55,553 million, up 16% YOY from INR 47,947 million. EBITDA stood at INR 8,636 million, up 16% YOY from INR 7,452 million in 9-monthly FY25. EBITDA margins were stable at 12.4%. Manufacturing EBITDA stood at INR 7,778 million, up 18% YOY from INR 6,608 million, and manufacturing EBITDA margin stood at 13.8%. Adjusted PAT stood at INR 3,714 million, up 51% YOY from INR 2,454 million, and PAT margins at 5.3%. Exports contributed 5.6% to our manufacturing revenue in 9-monthly FY26, that is INR 3,127 million. Net debt as of December 2025 stood at INR 7,767 million, and ROACE stood at 15.1%. Coming to the segmental performance on the manufacturing front, two-wheeler and three-wheeler contributed 81.5%, passenger vehicles contributed 4.8%, commercial vehicles contributed 8.3% for Quarter 3 FY26, and others would be 5.4%. With this, I would like to give this back to Mr. Sumit for his closing remarks on this opening note. Thank you.
Thank you, Mr. Ganu. Finally, we would like to share our vision for the company and where we are headed over the next few years. Since embarking on our public market journey, we've continued to strengthen and win in our core capabilities. In sheet metal fabrication, in stamping, and surface treatment, we've not only secured incremental program wins with our top 3 two-wheeler OEM customers, but have also achieved meaningful traction with the challenger OEMs customers that are growing rapidly where our historical presence was limited. This momentum is translating into increased market share, both with existing customers and across new large OEM relationships. Alongside this, we have deliberately established new verticals, each of which we believe has the potential to become a substantiative revenue contributor over the medium term. In steering columns, we now supply to all marquee OEMs in India across two-wheelers and three-wheelers, and have recently commenced exports to a global European OEM as well. In suspensions, we've made strong progress, expanding from engagements with 2 large two-wheeler OEMs at the start of the year to 4 today. In parallel, our execution in high tensile technology has enabled us to deepen relationships with existing Japanese customers while expanding our offering to Indian OEMs as well. We strongly believe that high tensile technology will see wider adoption in India over the next few years, as the industry reaches an inflection point driven by the need for lightweighting and enhanced crash safety, trends which are already well established in North America and in Japan. In addition, we're undertaking a fundamental strategic pivot in our approach to the defense and aerospace segment. This has been a focus area for us for some time, and through recent milestones, including our collaboration with Plasan and the acquisition of SDM, we're now working with 6 aerospace and defense OEMs within a very short span. We're bullish on this segment and expect to become a meaningful revenue contributor over the next few years. Lastly, a key commitment we made during our IPO and subsequent earnings calls was to simplify our corporate structure. We've delivered on this commitment in a very value-accretive manner for both public and institutional shareholders from day one. We believe this merger will enable higher wallet share, greater vertical integration, increased customer stickiness, and overall EBITDA accretion at the consolidated level. As we move forward with this vision, we would like to thank all our stakeholders for being part of this journey so far. This is only the beginning. With this, we can open the floor for questions. Thank you so much.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, in the interest of time and fairness to others, we request you to restrict to 2 questions per participant and rejoin the question queue. We will wait for a moment while we poll for questions. We take the first question from the line of Nitesh Mangal from Jefferies. Please go ahead.
Hi, good morning, and thanks for taking my question. Firstly, congratulations on getting the approvals for the merger of the promoter entities, and I must say it's coming at pretty attractive valuations. My first question is on the core business, where we have seen some dip in two-wheeler revenues as well as passenger vehicle revenues on a YOY basis. Could you explain what is leading to this, and how do you see the trend in these businesses going forward?
Thank you, Nitesh, for that question. Firstly, on the two-wheeler bit, I would like to talk about the outcome. So, in terms of revenues, the company's two-wheeler revenues remains largely flat on a sequential basis. So, we were around 15,085 million in the quarter 2 of FY26, and right now we're at around 15,041 million in quarter 2 of FY26. So, if you even look at the volumes of our top 4 customers in the two-wheeler segment, even their volumes have largely remained flat on a sequential basis. Hence, if you would have asked me at the start of October about where we would see volumes, this would largely have been an expected outcome for us. Secondly, I think if you look at the larger trend for tier 1, December usually is a slow month for the industry. So OEMs usually have a planned maintenance shutdown for at least a few days. And perhaps what you're also seeing is a bit of a lag between perhaps the numbers of the tier 1 players report and what the OEMs operate. Maybe a bit of timing gap is seen over here, and that's what we're probably seeing in this quarter. However, one thing I would like to point out is in terms of our two-wheeler growth in the 9 months, we're still outperforming the industry. We're still up 12% on a YOY basis if we, compare the 9 months of this year as compared to the 9 months of last year. And we see absolutely no issue in terms of us continuing to outperform the industry. Of course, in the coming quarter, I think we'll get a lot of help of the upcoming facilities. The one in Chennai for the leading EV platform for a two-wheeler OEM, the Belrise facility where we're supplying to a premium Japanese two-wheeler OEM, as well as the Haridwar facility for a leading two-wheeler OEM. So all three of these facilities will come into play in this quarter. And in that sense, we see absolutely no issue in continuing to outperform the industry and doing well going forward.
Thanks, Asad. Secondly, I mean, I do see you winning quite a number of orders in the new components like suspension, steering columns, height and style products, etc. over the last 1.5 years. How do you see these business scaling up, let's say, over the next few years, and how much can these components start to contribute to the top line in a few years?
Right. So thanks, Ranit. So firstly, I will talk about these components that you mentioned, including, suspensions or steering columns or high tensile components. So firstly, these are, as you mentioned, largely proprietary parts. So they require a fair amount of investment that goes into the IP itself. And because they are, say, parts that have IP and require R&D, usually OEMs have a very long gestation period to onboard these parts. Anytime they have to onboard any of these parts, they actually go through at least 9 to 12 months of testing, if not more, to kind of get to a stage like this. So I think what we've really achieved so far is really penetration or entry amongst multiple OEMs. So in suspensions, we started the year supplying to only 2 OEMs. Now we're supplying to 4 OEMs. These are all really large OEMs that we're working with. In steering columns, we're again working with all of the Indian OEMs as well as the marquee foreign OEMs, and also in high tensile components. Now we're working with almost all of the Japanese OEMs, as well as speaking to a couple of Indian OEMs. So across all of these segments, we have now entered multiple OEMs. So the entry and the broad basing of OEMs has been the critical part so far. Now the real key will be penetrating and gaining wallet share amongst all of these OEMs. I think the tougher part, if you ask me, is the entry itself. Because once a technology is established, to take it to an inflection point is not as tough as, say, entering in the first place. Now that we are in all of these OEMs, the purchase side, R&D side, production side is convinced of the benefits we're getting from this technology. Now all we have to do is, say, continue to win new programs and grow this business. In terms of where we want this business to be, we feel each of these 3 verticals, so suspension, steering columns, and high tensile components, each of them can be a growth vertical of its own. I think it would be pretty fair to say that each of them going forward can be multi-100 crore businesses. And this we're speaking about kind of a medium-term perspective in the next 2 to 3 years. So that's where we want our ambition to be. And we think we have the building blocks in place to achieve that.
Thanks, Ken. I have one more question if I can.
I'm sorry to interrupt you, Nitesh. If you could please join back the queue for follow-up questions.
Sure. No worries.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. We take the next question from the line of Vijay Pandey from Nuvama. Please go ahead.
Thank you for taking my question, and good that you have completed the acquisition, the related party acquisition. It was one of the key points which you highlighted at the time of IPO. So coming on to the Q3 numbers, generally the other suppliers which have reported the numbers, they have seen a good level of growth, especially for the two-wheeler segment. Even Bajaj Auto, their sales was up around 7% in third quarter. So I'm a bit confused that where our underperformance is coming from. Is it like any particular model, or how is it? Because I'm just not able to get that sense of why we have underperformed, even if I compare it with Bajaj Auto's number.
So while we don't comment on particular OEMs, you'd appreciate that our growth is based across multiple OEMs. I think we answered on why we think two-wheeler numbers have been fairly stagnant as compared to last year. Of course, there can be a bit of impact of mix, but that being said, it's not like we're losing any programs. We're continuing to get more RFQs, win more programs. Of course, different OEMs go in different segments. It's not, say, straight sailing for each of them. There can be certain models that do well, certain models that don't do well. So we, of course, don't inform OEM strategy in that sense. What we can talk about is what we are hearing from the OEMs and the plans that we're setting up for them means that we are well on track to achieve the numbers that we have guided for, not only in the two-wheeler segment, but also as a larger company.
How do you see currently the demand looking like? So for the fourth quarter, do you expect it to be positive mid-single digit growth going into the fourth quarter, or should we expect a flattish growth?
We won't be commenting on quarterly guidance. We have an annual guidance that we give to all analysts and investors, and we maintain that going forward. Of course, the GST rate cut has been positive. I think the numbers for January should be out soon, and they show quite a positive trend.
Okay. Just if
Vijay, I do apologize.
No, it's a follow-up to the same question.
Please go ahead.
Just want to check. How is the inventory situation at the OEMs level? Because some of the OEMs have guided that the inventory level is in single digits.
We don't comment on OEMs or our customers.
Okay.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and one. Ladies and gentlemen, if you wish to ask a question, please press star and one. We take the next question from the line of Jimit Shah from Motilal Oswal Financial Services Limited. Please go ahead.
Hi, am I audible?
Yes.
Yeah. Hi. Thanks for the opportunity. Just a couple of questions. So one of the key growth strategies for us was taking the CPV for the number one and number two OEMs from 12,500 to 17,500. So now it would go to 20,500 with the inclusion. And for number three, number four to go to 12,500 first. So where are we in that journey? Is there traction from the OEMs? Any update on that?
Right. So I can talk about maybe one of our marquee OEMs, with one of the larger OEMs that we work with. We've already gone from, say, 12,500 to 14,000 with the addition of steering columns. And with this acquisition, with the same OEM, we've gone close to 17,000. And as we speak, we're also in discussions with them for two new products, which we think can take it from 17,000 to, say, upwards of 18,000 over this fiscal year. So with one OEM, we're already seeing that journey from 12,500 to 18,000, which is a close to 45% increase. And that is something that has, say, happened over the past few months. One thing I would like to point out is usually when you enter a new product, of course, you'll not get a lion's share of the wallet share immediately. OEMs usually introduce you to one model, and then based on performance, kind of broad-based your growth amongst different models. So I think the entries are important, and those are the things that are happening as we speak. Now we'll continue to grow them. In terms of the second question on taking our third and fourth largest OEMs to higher levels, so I can talk about one of the larger two-wheeler and three-wheeler OEMs, which is in that category. And with them now, we've started on two different things. One, we are supplying to them for their premium segment. So by supplying to them in their premium segment, our content per vehicle has gone up by around 1.8 to 2 times specifically for them. Secondly, for the same OEM, we have now entered the plastic commodity segment. And by entering the plastic commodity segment, we are now supplying a wide variety of products, including fenders, cowls, covers, dashboards, visors, all relevant plastic parts, which can result in an increase in cost per vehicle around 2,000 rupees. And maybe with another premium two-wheeler OEM, we are basically doing more of the suspension part. So suspension entry has just happened recently, and that will also lead to a content per vehicle increase of around 1,500 rupees. So just to summarize, our top OEM, we're kind of growing quite fast, increased content per vehicle by 45%, and with say our third, fourth, fifth type of OEMs, there's a continued increase of new commodities that we're selling to them.
So, thanks for the detailed answer. Secondly, on the overall business side of things, on the core business, so two-wheeler OEMs have been very gung-ho on the demand going ahead. So Q4 numbers expected to be very strong for all two-wheeler, three-wheeler OEMs, and a relatively low base of H1 for the next year also bodes well for the industry growth. So is there any ramp-up of schedules from the OEMs that you've seen, or anything on the demand front that we are expecting?
So in general, we don't comment on the schedules that we get from OEMs. I think the numbers are out for everyone to see in terms of the January production numbers for OEMs. I think, as you mentioned correctly, the numbers seem positive and seem to be going in the right trajectory. We maintain our guidance of outperforming the industry in two-wheelers substantially, and also kind of maintaining that mid-teens kind of revenue growth going forward.
So, thanks for that.
Thank you.
Thank you. We take the next question from the line of Shubham Jain from Investec. Please go ahead.
Hi, thanks for the opportunity. My first question was on defense and aerospace growth prospects. How do we see this business scaling up over the next few years? And the second question was a bookkeeping question. The tax rate this quarter seems to be high at about 29%. What should be the tax rate number that we should work with here? Yeah, that's all.
I can take the first one. Yeah, from a defense perspective, I think as we mentioned on the call, fundamentally we started working with 6 new OEMs. There is very, very positive traction from domestic as well as international OEMs. I want to supplement that with saying not just defense, but defense and aerospace. Aerospace is an area for us that we're looking at very keenly. We have already entered supply chain of 2 of the largest players in that space. And as I'm sure you must have seen in the news over the past few months of the year, the largest OEMs in the aerospace industry, in the aviation industry, are looking at India very, very seriously. They're looking to set up manufacturing or sort of source more from India and also manufacture in India. We want to capitalize on that positive trajectory. While the French acquisition is an entry mechanism for us to start very close engagement with the European counterparts, with the European OEMs, we want to fundamentally set up manufacturing facilities in India for the aerospace and defense vertical, which is currently in the works. Largely, in the medium term, we see this as a very, very positive and meaningful contributor to our revenues going forward. I unfortunately cannot comment on the specific numbers, but it will be a meaningful contributor in a short time.
Yeah, and to answer your second question on the tax rate, I think over the course of the year, we'll see this normalize to around 20 to 24% of corporate tax rate.
Thank you. We take the next question from the line of Viraj Sanghvi from Ambit Capital. Please go ahead.
Hi, thanks for taking my question. So my first question is on the four-wheeler part. We've mentioned in the merger presentation that the post-merger exposure to four-wheelers is rising sharply than what we have currently. So can you provide more color as to what is the customer profile over here? Is it largely e-four-wheeler OEMs, and what are the kind of products? And what is the change in CPV on the four-wheeler side post-merger, if any?
Right. Thank you, Viraj, for that question. So just to shed some light on that, we'll be adding close to 1,000 crores of revenue or 10,000 million INR of revenue post-merger, and around 34% of this would be geared towards passenger vehicles as well as commercial vehicles. I think two major parts of what we'll be supplying to passenger vehicles and commercial vehicles. Number one will be the copper bus bars, which are extremely important from a battery and battery management perspective, since it's a critical part that rules conductivity in a system. And secondly, these companies also have a decent exposure in the plastic segment, so supplying a lot of different parts like dashboards, tire covers, tire wheels, and interior infotainment parts for marquee passenger vehicle OEM. So in terms of mix, we actually also work with a four-wheeler Indian domestic OEM for the bus bars, and for the plastic parts, there's a wide variety of OEMs, including a couple of European OEMs as well as a couple of domestic OEMs, some of which is direct and some of which is through a tier one, given that a lot of these parts go into infotainment systems which are, say, managed by particularly tier ones. I think the content per vehicle increase that we can see in four-wheelers would be slightly higher, would be close to 5,000 rupees that we'll be able to see.
Thanks. Secondly, from this quarter's perspective, we've seen a decline in the PV revenues as well. So could you shed some details on how the two-wheeler performed, but any color on why the decline was there on the PV side?
So on the PV side, a couple of factors coming together, contribute to it. So firstly, in the last quarter and this quarter, there were some supply chain issues with one of our largest Europe-based four-wheeler OEM, which is a premium automaker. And in fact, this OEM is also our largest four-wheeler OEM. And as they've struggled volumes, of course, that has had a negative impact on our revenues. Second was, as we announced last time, we are setting up a facility in Bhiwadi for plastic molding for one of the largest Japanese OEMs. This plant was being shifted from another location. So during the shifting, of course, there was a bit of loss of production. However, that is transitional, and you will see it getting recovered in the fourth quarter of FY2026. Another important point I'd like to highlight is H1 and Belrise both also work a lot in the tooling and dies industry, where we supply tooling to a lot of marquee Japanese as well as Indian passenger vehicle OEMs. This has been categorized in the others category. So while these sales are in the end happening to a passenger vehicle OEM, we have technically classified them as others because it's a kind of different product category. And just fourthly, on a broader perspective, if you look at our passenger vehicle numbers, we're still up 24% on a year-on-year basis if you compare 9 months against 9 months. And hence, we again don't see any change in our guidance, which is to double our four-wheeler and commercial vehicle revenue in the next 2 years as compared to FY25 numbers. So I think we can definitely achieve that, and there's no reason why that should not happen.
Got it. Thanks. Lastly, just want to
Viraj, I would request you to please join back to the queue.
Sure.
Thank you. We take the next question from the line of Naveen Mata from Mahindra Manulife Investment Management Private Limited. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Just another kind of follow-up on the two-wheeler growth being lower for us in this quarter. I just wanted a little more understanding. When we look at your mixes, two-wheeler plus three-wheeler is about 64%. Is it possible for you to split this between two-wheeler and three-wheeler, or what would be the composition of this?
Thank you, Naveen, for the question. So this would largely be two-wheeler. While I don't have the exact number in front of me, I think it would be close to 60% two-wheelers, probably 3 or 4% three-wheelers.
Okay. Because when I look at your largest customers' production growth YOY, it looks like two-wheelers is about 3-4% growth and three-wheelers is about 30% growth, which is why the question that if we have lesser saliency in the three-wheeler mix, is that the reason why our number is kind of trending flattish or kind of broadly in line with our largest customer? Is that the explanation, or do you think there's another way to kind of look at this?
I think that's also a fair way to look at it. I think another important point that I would like to highlight here is that our penetration in the three-wheeler sector is going up. So for our largest customer or for a couple of our largest customers, we have won orders with them across their upcoming chassis systems for their upcoming three-wheeler platforms, both across ICE and EV. We've also won additional orders from them for suspensions, both in ICE and EV. So you're right. Right now, the presence in three-wheelers per se is lower, but I think that is also going up in the future.
Fair enough, sir. That's it from us. Thank you.
Thank you.
Thank you.
We take the next question from the line of Radha from B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. So my first question is, I wanted to understand how big is the market size of plastic components in two-wheelers and three-wheelers and four-wheelers separately in India? And is this business entirely outsourced by OEs in India, or is there a captive market share also?
I would probably have the two-wheeler numbers handy on me right now. That market, for a limited size of products, if I just consider three products, which is a fender, cowl, and cover, that would be close to a 500 to 600 crore market. Of course, if you add the dashboard and the visor and the helmet accessories, I think my best guess would be this would be close to 2,000 crore market on a console basis in the two-wheeler segment. I unfortunately don't have the numbers handy on me for passenger vehicles. And whether this is all outsourced, yes. I don't think any OEM does a lot of plastic manufacturing in-house. It is usually outsourced to tier ones like ourselves.
And what is the maximum content per vehicle that can be reached in these products in two-wheelers and four-wheelers separately? So this would help us understand how big can this business become for us.
So one thing I'd like to point out is when it comes to plastic molding or say fabrication, I think the process largely remains the same. So we can say manufacture almost all components that go into a two-wheeler or four-wheeler using a similar plastic injection molding process. So in say two-wheelers, I think the content per vehicle that we have guided for is around 2,000 rupees that is there currently, and of course that going up with fairing assemblies, which have a bit of plastic as well as a bit of metal. So that can say go from 2,000 rupees to around 3,000 rupees. In four-wheelers, it's tough to comment on a content per vehicle amount because there's a very wide variety of products that go into a four-wheeler, and usually each of them are managed by system integrators. So it depends a lot on which system integrators you're working with. If you get entry with system integrator or become a system integrator yourself, that's a very lumpy type of growth that you get in four-wheelers.
Yeah, just to add to that, in the four-wheelers especially, it's more complex because, like Swastik said, it is system integrators, and these are much larger assemblies that they supply now, the tier ones especially. A lot of it also includes a part of the system. It includes the side panels. So all of this comes pretty much well furbished and just ready to fit. So apart from plastic, there are other parts also which get into it. So it's really very difficult to analyze as to what would be the total content when you look at such kind of assemblies being supplied to four-wheelers.
Understood, sir. Thank you and all the best.
Thank you.
Thank you.
We take the next question from the line of Raman KV from Sequent Investments. Please go ahead.
Hello, sir. Can you hear me?
Yes,
Hello.
please go ahead.
Yes.
Yeah. My first question is with respect to the merger of the promoter-owned entities. So together, this Badwe Autocomp and Eximus Infra, they did around 2,100 crores of revenue in FY25. I just want to understand how they performed in the current 9-month period for the financial year FY26, and what do you expect the growth of these two entities to be in the next 1 or 2 years? One is that, and as you mentioned, this will reduce the related party transaction by 1,200 crores, which will basically add around 1,000 crores to the revenue of Belrise. So I just want to understand by when this will be finalized, by FY26 or FY27?
Right. So I think to answer your second question, this is of course subject to a lot of regulatory approvals because we'll have to get the approvals from the exchanges as well as the NCLT for the merger to be finalized. And I think the timeline that we've indicated in our presentation is anywhere between 10 to 12 months. So you can assume that this happens within FY25 itself. And sorry, what was your second question?
My first question was the growth with respect to the Belrise Autocoms and Exumus Infra.
Right. So in general, we'll not be commenting on the growth for these companies of now. Once we get greater clarity of when and how these companies are being merged, we'll speak more about it then.
Understood. Just a follow-up on this. Both of this merger, I mean, it will reduce your excess corporate overheads. These mergers will be margin accretive as well, right?
So of course, when your RPT revenues are getting netted off and the EBITDA is being added in, so I think if you look at the EBITDA margins of these two entities, they're say close to 12 to 13%. So fairly in line with what Belrise EBITDA margins are. So imagine that the revenues are getting netted off, but the EBITDA is getting added in. So in that sense, of course, it should be EBITDA accretive as well as PAT accretive.
Understood, sir. And sir, what is
Raman, I would request you to please join back the queue for follow-up questions.
Just a follow-up. I just want to understand the debt and cash in this both the entities.
So I think that's part of the presentation. You can just take a quick look at it.
Okay. Thank you, sir.
Thank you. We take the next question from the line of Ashwin Patil from LKP Securities Limited. Please go ahead. Ashwin, please unmute your line and proceed with your question.
Sure.
Since there is no response, ladies and gentlemen, due to time constraint, we take that as the last question and we conclude the question and answer session. I now hand the conference over to the management for their closing comments.
Thank you, everyone, for your time, interest, and questions.
Hey, everyone. I would like to put management. Everyone for their time, interest, and questions. I hope we have been able to address most of your queries. We remain confident in our growth trajectory, both near-term and long-term, driven by strategic investments and our commitment to advancing products and technologies. For any further queries, please reach out to us or to our IR partners. Once again.
Thank you. On behalf of Belrise Industries Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.